Do we hit a peak and was that a bubble or a hyper spike, and now it's going to keep going down, and get out while the getting's good, etc.? Or is this just how it goes? Is this a normal, I'll say normal, like not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I'm sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact.
Gold continues to attract attention as investors navigate a landscape shaped by inflation, geopolitical tensions, and growing uncertainty in global markets. Recent price weakness has led some to question whether the rally has ended or if a much larger move still lies ahead. Jim Rickards, a well-known economist, author, and financial commentator, has spent decades analyzing financial crises, currencies, and precious metals. Jim Rickards emphasizes that the recent decline in gold should be viewed as a normal correction rather than the end of the bull market. He argues that the key drivers behind higher gold prices remain firmly in place. Central banks continue accumulating gold, demand from China remains strong, mining supply growth is limited, and inflation pressures continue to affect economies worldwide. According to his outlook, the current pullback represents a temporary drawdown before the next major advance. He maintains that his intermediate-term target of $10,000 per ounce remains intact, potentially arriving by late this year or early next year. Rising geopolitical risks, particularly in energy-producing regions, could further support demand for safe haven assets. With supply remaining constrained while demand increases, he believes the long-term direction for gold remains decisively higher. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
End of January hit an all-time high. It was 53, 55. That was a closing price. You can get different numbers intraday depending on what ticker you look at, but call it 5,400 for a round number. But I think the ticker I use said 53, 55. It's down around 4,000 an ounce. It dipped a little bit below that. It was a three handle there for a while. It was like 3,900, 3,950, something like that. But you're right. It seems to have settled in around 4,000. So we all see the price action. The question is, what is this? Did we hit a peak and was that a bubble or a hyper spike, and now it's going to keep going down, and get out while the getting's good, etc.? Or is this just how it goes? Is this a normal, I'll say normal, like not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I'm sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact. Now, that's easy to say, but let me kind of look behind the curtain a little bit and kind of analyze that. The fundamentals have not changed. When I say fundamentals, uncertainty in the Persian Gulf, uncertainty in the war in Ukraine, central banks are still net buyers. China's buying hand over fist. Mining output is flat. I'm not saying peak gold in terms of mining, but when you have flattish supply and rising demand, that's a recipe for higher prices. And pardon me. We can all see what's going on with inflation. So none of those fundamentals have changed. So what did happen? Well, a couple of things. Number one, when the war in Iran broke out at the end of February, but you can kind of see it coming, they shut the Straits of Hormuz, and there was a time it was a double blockade. Iran was blockading the Straits, and the U.S. Navy was sitting out in the Arabian Sea. So Iran didn't let anybody through unless you were a friend of Iran or China and you paid a toll. But if you met those criteria and you got through, the U.S. Navy was waiting outside to board your vessel, blow you up, and turn you around. So how many people in the world were friends of both? The answer is nobody. You were either pro-Iranian, then the Navy stopped you, or you were anti-Iranian, and the Iranians stopped you. So it really was shut off. And I don't have to recite all the statistics. We all, 20% of the world's oil, 20% of the world's liquid natural gas, the larger percentage of the sulfur. People are like, what the heck is sulfur? I mean, they know what it is, but like, why is that so important? It's a precursor chemical in just about every important chemical process you can think of. And then also a major source of helium. Like, yeah, you blow up party balloons. No, yes, but you need helium to make semiconductors. So, and then aluminum, and then nitrogen, nitrates, to make fertilizer, to feed the world. The implications of this are mind-boggling. Again, people have been through that for the last couple of months. Some vessels are getting through right now, but not that many. Even on a good day, it's less than half the prior traffic. So the idea that, the coast is clear is just not true. Now, what does that have to do with the price of gold? The world needs oil. Now, there is oil around. The U.S. is not going to run out of oil. We have seen higher prices. We're not immune from a world price, but we're a net exporter. We get plenty of oil. We've taken over the Venezuelan oil. We're good friends with Guyana, right next door to Venezuela. They might have larger reserves than Venezuela, for all we know. So we're still exploring that. We kicked the Chinese out of the Panama Canal. And Trump's opening up leasing opportunities for oil and natural gas on federal lands, the Gulf of America, Alaska, and elsewhere. So the U.S. is not going to run out of oil. Neither is Russia. But they don't have enough to supply what's missing from the Persian Gulf. So will we send some to Japan because they're friends of ours? Yeah. But what does that do for Malaysia and India and in Africa and Europe, for that matter, and other places? The answer is not much. Russia could supply all the natural gas Europe needs, but the Europeans just seem to be intent on economic suicide, basically cutting off the Russians for no good reason. So again, how does that affect gold? Well, the answer is all of those commodities I just described are priced in dollars. They just are. And if you want those commodities and they're in short supply and the price is going up, you need dollars, and the price goes up more, you need more dollars. Well, how do you get dollars? Well, one way to do it is to sell gold and get dollars. So that created the downward pressure. In other words, countries, they said central banks are net buyers, and they are, but some countries, including Turkey, Russia to some extent, China and others, sold gold to get dollars to buy oil. So the downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends, all the things we were just talking about. It had everything to do with the fact that the world was short of dollars and needed them, and one way to get them quickly, because it's liquid, is to sell gold. So that starts the downward price pressure. Then it feeds on itself. So all of a sudden, leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. They're like, hey, it's going down, sell more. And then you hit more stop losses. It feeds on itself, and it keeps going down. So the trigger was the dollar shortage. So it was sell gold, get dollars to buy oil because you need the oil. And then the momentum continued for the reasons I mentioned, which is stop losses and just, momentum traders.
Global energy markets remain under pressure as geopolitical conflicts continue to disrupt critical trade routes and commodity flows. Concerns surrounding transportation bottlenecks, energy security, and supply chain vulnerabilities have become increasingly important for investors and policymakers alike. The disruption of major shipping routes has implications far beyond crude oil prices. Energy products, natural gas, industrial inputs, fertilizers, and key materials used in manufacturing all depend on smooth global transportation networks. Reduced traffic through strategic waterways has increased uncertainty regarding future supply availability and pricing. While some market participants believe the worst may be over, underlying challenges remain unresolved. The broader concern is that prolonged disruptions could contribute to higher inflation and slower economic growth. These conditions often strengthen the appeal of hard assets such as gold. If energy markets remain constrained and geopolitical tensions persist, safe haven demand may continue to grow. Such developments could reinforce expectations for significantly higher precious metal prices over the coming quarters, while increasing volatility across financial markets. Now, let's get back to the interview.
2008 turned into a global financial crisis, but as we all recall, it started in the subprime mortgage market. There were $1 trillion of subprime and so-called all-day mortgages. And a lot of people said, well, we could have 20% losses. It's only $200 billion. What's the big deal? What they ignored was that there were $5 trillion of derivatives piled on top of the $1 trillion of junk mortgages. And that's what got, AIG Financial Products and Goldman and everyone else in pretty deep trouble. But it was huge, and we got the Treasury and the Fed involved, et cetera. But now we're seeing it in multiple dimensions. there is a global dollar shortage, and people say, how could that possibly be with all the Fed money printing? But the Fed money printing is sterilized because the Fed prints money by buying treasury securities. So the Goldman and Morgan Stanley deliver the treasuries to the Fed, and then the Fed gives them cash that comes out of thin air. Okay, that's money printing. But then they take the money and give it back to the Fed in the form of excess reserves. So all you're doing is inflating the balance sheet of the Fed on both sides. You're not creating money that does anything for the economy. It's not stimulus. That's nonsense. But in terms of M1 and M2, there is a severe dollar shortage. And that goes back to what we said earlier about selling gold for dollars to buy oil because you're short of oil and dollars. So that's a problem. But we have a huge crisis in private credit. Now, private credit is just, old wine in new bottles, as they say. It's just the junk bond market. But instead of junk bonds and Mike Milken and, Rodeo Drive and all that stuff in the 1980s, what we have are funds that invest in loans basically to junk credits. We've seen some big bankruptcies at Tricolor and a couple, instead of subprime mortgages, subprime auto loans, but it's not limited to that. Massive, $100 billion and more loan portfolios to these hyperscalers and AI data center builders, et cetera. And all of that is collapsing. Now, because they're funds, you don't actually see some of the borrowers have gone bankrupt, but you don't actually see the distress because it's boxed into the fund. What happens is the investors gave notice to the fund managers, who are the biggest names. It's KKR, BlackRock, Blackstone, and others, Apollo. Again, these are the biggest names in the industry, saying, "I want my money back," and the managers put up gates, and they say no. And I've written scores of private offering documents, and I've read hundreds, so I know what's in the fine print. But it starts out, here's what we do, and here's how much money we're going to make, and here's this notice periods and how you get your money back. And somewhere around page 50 in fine print, it says, "Oh, by the way, if there's a market distress or disorderly markets in our sole discretion, we reserve the right to not give you your money back." People usually gloss over that, but it's there, and that's what they're doing. So now people are saying, "Give me my, whatever 500 million back," and the managers are saying, "You can have 5%. Here's 2.5 million, but we're keeping the other, whatever 497.50 million, and we'll get back to you." And that's what they're doing. So now that doesn't mean it's all good on the asset side. The assets are collapsing, but nobody wants to mark them to market because then the accountants get involved and they say, "Hey, this guy just marked this thing down. You own the same thing. You got to mark it down. Why is your value down?" And then the whole thing implodes. So right now, everyone's holding their breath, walking on eggshells, and pretending there's nothing wrong, but there's a serious problem there. And then, but I keep going, and we've got the wars we talked about, an escalation. So looking at the price of oil, the Persian Gulf, Ukraine, private credit, dollar shortage, over leverage, an AI bubble. I'm not against AI. I wrote a book about it, but I see 4 or 5 different stress points or bubbles all at the same time, not just one. Any one of them could cause a crisis, but you combine them, you're talking about, I hate to use cliches, but the mother of all financial crises.
Beyond the immediate fluctuations in commodity markets, a larger economic transformation appears to be unfolding. Investors are increasingly focused on the interaction between inflation, resource scarcity, geopolitical competition, and monetary policy. These forces have the potential to reshape investment trends for years to come. A major theme is the growing imbalance between rising demand and limited supply across several critical sectors. Gold stands out because many of the factors that initially fueled its rally remain active today. Central bank purchases continue at elevated levels, inflation remains a concern, and geopolitical instability continues to influence investor behavior. At the same time, disruptions affecting energy transportation and global trade could create additional pressure on already fragile supply chains. The prediction remains that gold could eventually advance toward the $10,000 level as these trends unfold. Rather than signaling the end of the cycle, recent weakness is viewed as a consolidation phase before another upward move. If economic uncertainty intensifies and investors continue seeking protection from currency depreciation and market volatility, precious metals could emerge as one of the strongest performing asset classes in the years ahead. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.